And so this idea of a balanced scorecard, right, is that we can't just assess investment decisions in financial isolation, right? It's easy for us accountants, especially when you go into financial accounting, we learn that everything's measured in dollars. But that's not a fair assessment for the reality of how the world operates. We have to worry about, are our customers happy? Are our processes effective? Are we learning? Are we growing as a company? And so a balanced scorecard looks at all four of these metrics, but you can also make your own scorecards and choose what's the values that are appropriate for your company when you go into studying company strategy and marketing strategy. But what they're saying from this book, the most common is customer. So whenever we're working on our business, we want to look at customer satisfaction. Are we acquiring new customers? Are we delivering on time? How much of these are new deliveries? How much are retention of old customers? What's our returns look like? How quickly are we taking care of these orders? From an internal process standpoint, are our products defective? Are we able to maintain a good uptime? Are the cost efficient? Are we paying good costs? Are we using good quality? Are our labor hours good? Is our staff good? Are employees happy while we're working here? Smart, happy employees make normally for a better company. Are we spending a lot of money on training? Too much, too little? Are we getting new products, new patents out of this? And are we spending a lot of money on research? And then ultimately, all of that should drive financial, our income, our ROI, our sales growth, our cash flow, our stock, which ultimately drives the stock price. So we need to be focused holistically on the company, not just on the financial perspective as a manager. It doesn't matter at the end of the day if you have the best department in the world, if everyone hates working for you. Eventually, no one will want to work for your department, and it'll go, your financial performance will drop. Same thing, could have the best selling product in the world, but if you have no good customer satisfaction, I think the common example now is Apple with not selling the chargers. A lot of people are pushing back on that. It's not really it doesn't really lead to customer satisfaction, even though they have good products, they have good and happy employees. But if they miss the customer piece, they have to do other things to keep their customer happy, or eventually they'll have some kind of financial result as an impact. And so the most complicated piece we're going to talk about here is transfer pricing. And so transfer pricing is a method of setting prices between departments. So if I am department A, like this is the LCD, they're making screens, they can sell the screens theoretically to other companies, or they could sell them to individuals, or they could also sell their screens or move their screens to that phone division for the screens to be used on the phone. And so then we have this issue of how do I set a price for one department when the screen department, when the phone department, for my phone department, even though they're both my company's departments. But we have to track some kind of cost, because the phone department could buy from external users, or they could buy from ourselves. And we need to fairly track the screen division's price in order to make sure that they are being rewarded accordingly. If they're selling a lot of products to the phone division, they shouldn't be punished for that because they're doing a good job. Problem here is none of this is GAAP accounting, right? We can't sell to ourselves in GAAP accounting. We can only sell to external customers. So we look at this is more for management. So remember, don't get confused with GAAP accounting. GAAP accounting, if we sell to ourselves, there's no new net income effect. But in managerial accounting, we want to know the differences so we can correctly reward the company. So the idea here is a transfer price is the amount we charge another division. And so we're saying here, our selling price to outside customers is 80, our variable manufacturing cost is 40, our fixed manufacturing cost is here. So because the S phone can purchase displays from $80 for other companies, we'll set some kind of transfer price at about $80 per unit to make sure there's a fair representation to the LCD division. Even though in reality, right, they're not really paying for it. It's just so that we make sure budgeting works out. More formulas here. I know it's a lot. Memorize them. Please, please. I'm going to test you on these. I'm going to make sure I put them on the final because you're going to have to know these in every single one of your classes. I'm purposely avoiding the stuff that's convoluted, that I think you're not going to use a lot in real life, and that like when you take your CPA exam, sure, you'll have to learn all the variable overhead methods for allocating standard costs. And maybe when you take your cost accounting, but you're never going to use them again unless you really focus on budgeting, which a lot of you won't. But every single one of you, if you go into finance or business, need to know these formulas. So memorize them. So write this down. Cash conversion cycle is number of days in receivables plus days in inventory plus minus days in payable. And this is saying how quickly do we collect cash? How quickly can we convert a sale into cash? And that's a whole cycle, right? We make inventory, we have inventory in the books, inventory is sold and it is in accounts receivable. We've purchased that inventory of accounts payable. So how quickly does that accounts payable turn back into cash for us? And so memorize all these different formulas from the day that we pay for the inventory for the day that we get money back. That's important. If I know that I have an accounts payable outstanding, that takes a month, and then it takes another month for me to sell the inventory, and then another month for me to collect on the accounts receivable. The day that I put in a purchase, it's going to be 3 months before I collect cash. That's where like working for your own business gets very complex from like an accounting firm perspective or consulting firm perspective. If you're an employee, you don't have a lot of risk. You get your paycheck every 2 weeks. Part of the reason you get paid less than if you're running your own business is to run your own business, you have to have some kind of collectability risk. You find a customer, you invoice the customer every 30 days maybe, and the customer has 30 to 60 days to pay you. So you might perform work on day one that you don't get paid for 3 to 6 months. And you have to make sure you can survive on that deferment of cash, on the cash being deferred. That's why the cash conversion cycle is important to understand. And here's all the formulas for each under them. Day sales and accounts receivable, we're looking at how quickly can we convert an account receivable into sales. Or how many days does it take us to convert a sale into accounts receivable? How many days does it take us to, how many days is an inventory in our sales? How long does it take us to sell inventory? How long does it take us to collect on our accounts receivable? How long does it take us to pay our accounts payable? And then here's the cash conversion cycle. They're saying here it's about 10 or 8 days. It shows you all the different calculations. I don't want to go through all these calculations and spend everyone's time. It's a simple division, and multiplication. Just make sure you go through it. Now we're in our appendix. Again, appendix, I'm not going to test too much on in the final. Just want to make sure that we're aware of it. So nothing will be unfamiliar for you if you're doing it on your homework or quizzes or you get in another class. Oh, and so this appendix specifically is how they calculated. At the very beginning of our lecture, we had this Excel sheet that we talked about these calculations. Where's that Excel sheet? This here, this department income statement. And it was asked, how did we allocate these different departments, the indirect expenses and the service or cost centers. That's in this appendix. So I've given the PowerPoint to you. They're all simple multiplication division, but this is where we see how the simple multiplication division pans out. So I actually won't spend any time on this because I talked about the high level concept earlier, and you can go one by one if you want to. But in homework, quizzes, and the test, I'll just be asking very general questions, and that's what I expect them to know. Yes, we have to apply the indirect costs. Yes, we have to apply and allocate the service centers or cost centers, as you will. But ultimately, if I give you like something like square footage and say apply indirect costs by square footage, that you are able to determine the percentage by square footage, and then determine what are indirect costs, and then allocate. And what might throw you off there, if I have a cost center, you have to also allocate the cost centers, right? If I don't, then just allocate the indirect costs. And so this next piece is transfer pricing. So transfer pricing, we talked about a little. I think that, I'll go into a little more detail about the transfer pricing. I think this is useful. So we talked about transfer pricing, the point of the transfer pricing itself is to make sure that we allocate some kind of sales cost to our departments. It's non-GAAP. And when we have one department selling to another department. And so the idea here is the transfer price generally will be somewhere between what it costs us and what we sell to outside customers. The most fair one is to what we sell to outside customers, but really the range can be whatever the company decides. So we kind of covered that piece. And then joint costs and their allocations. This is just more ways for us to talk about splitting allocation costs. So joint costs are incurred to produce and purchase 2 or more products at the same time. So they're saying consider a sawmill company. So let's say you get a log, and the log, all the sawmill does is make different qualities of wood. So we get one type of log, we cut the costs, but we get different types of products. We get clear products, select products, and then common products. How do we associate these joint costs and allocate them to the end products? And it's going to be the same. We take a % of the total costs and we'll allocate it based on how much feet we produce, some kind of allocation base. So the theory doesn't change at all. And we're always going to give you an allocation base. We're always going to give you some kind of cost associated. And then you're just going to take a percentage of the allocation base, multiply it by the costs, and you'll be able to figure out your final allocated cost. So you might get a 30,000 here, you might get 100,000 board feet in this information. And then you have to divide this to find this percentage, multiply this to get the allocated costs, and then you can figure out your gross profit. This might be on your homework, but not going to be on a test. Not too complicated. That's it for the end of chapter 9. Hopefully that chapter is a little more simple. Main thought here is the indirect cost and department costs. So any questions?